Hello YouTube! In today's video we're going to cover hidden deductions of real estate investing that a lot of people might not be aware of, especially when they're new to becoming a real estate investor. Knowing this information ahead of time can make the difference between you being able to deduct zero of this all the way up to $25,000. Hi, my name is Mike Kelly, owner of Mike Kelly CPA, where on this channel I help people master business, taxes, accounting, and money. A good portion of my client base in my accounting practice actually happens to be real estate investors. And a lot of the newer investors who come to me really have not heard of this concept. And if they have heard of it, they're not sure of why they get it some years and why they don't get it in other years. And so what I thought would be a good idea is to make a video that I can share with everyone so people have a better understanding of how all this stuff actually works. As we dive into this, guys, there's a few things you can do to really help support the channel. One is if you haven't subscribed, be sure to do so. Hit the bell notification icon, like the video if you like it, dislike it if you dislike it, or leave a comment below. All those things really help the YouTube algorithm and spread the reach of this video, and really helps out the channel, so thank you so much. Now, I could stand behind this microphone, behind this camera, and say this is some really secret stuff. Like,
This is the secret tax law you've never heard of.
but then I would sound like I'm trying to sell you a course, right? But this is truly not the case. In fact, most tax deductions and tax rules are really not that secret. It's just more so knowing where to look to find the information. The information's out there. The hard part is finding the information. And so that's what we're going to break down as we look at some examples on screen. Let's go through this and learn how we could potentially give you some extra deductions on your tax return that can not only offset your rental income, but can potentially offset things like your wages, interest income, dividends, and other forms of income. Let's go. Now, in most circumstances, as a real estate investor, in order to deduct losses, which in real estate investing are typically passive losses, you might have heard that term. The passive losses can only offset passive income, which is rental income is a great example of that. Generally speaking, we cannot take our rental loss against our other forms of income. But in this particular case, there's a very special rule where you can, even if you're not a real estate professional, which I won't go into the details of what that is, but most people, quite frankly, are not real estate professionals because they don't do real estate full-time or close to full-time as an investor. What they can do, though, is the IRS allows, under the code, that a person can take up to, if their income is under a certain threshold, which we're going to talk about in a minute, they can deduct up to $25,000 of that normally passive loss as a non-passive loss, meaning it will help reduce their wages, help reduce their interest income and things like that, and ultimately will save them a tremendous amount of taxes if they're allowed to do that. Otherwise, what happens with that loss, if we can't deduct it against our other forms of income, well, then the loss just carries forward into the next year until we have more rental income, passive income, to absorb that passive loss. And by the way, you might find that in some years you're able to benefit from this rule, and in other years you're not able to. But we're going to talk about that as well. Like most tax deductions or tax rules, there are income thresholds or limits. And so in this case, the adjusted gross income limit, or AGI limit, is $150,000. Once your income reaches $150,000, well, what happens is your ability to make that passive loss non-passive completely evaporates, unfortunately. If you can't deduct it against your other forms of income, though, that loss can still, you don't lose it, it still carries forward on the 8582 form until you have more passive income to absorb it. Now, what's unique about this is whether you're married filing jointly or filing single, that income limit's still $150 either way. And so you have some leeway there. At the point at which your adjusted gross income reaches $100,000, this is what I want you to understand, so listen closely. So once your income reaches $100,000, for every $2 you earn above $100,000, you lose $1 of the potential deduction that goes up to $25,000. And so in the examples we're going to look at now, you're going to see kind of how that works, and you can have some examples to study for yourself, just so you're more in tune and aware of what's going on with these rules. And the last thing before I forget to mention, before we're going to look at these examples, is that it does matter how much you participate in managing your rental. Absolutely. If you have no involvement in your rental, in terms of you don't make any management decisions, you don't screen tenants, you don't try to repair the property yourself, you know, you can call in others to repair it for you, that's fine. But if you are not functioning in a manager type of role on the property, then you might not have enough time invested in the property to take advantage of this special deduction. So you don't need to be a real estate professional, which requires 750 hours a year or more to do this, but you do want to at least have significant participation, which is usually at least 100 hours or more into managing the property, whether that's you physically doing the repairs yourself, you making phone calls, management decisions, screening tenants, checking the credit of the tenants, reading financial statements about your rental doesn't count towards those hours. Traveling to your property doesn't count towards those hours. So there's certain things that, and I want to cover more of those type of rules in a different video, but there are certain things you can do that fulfill that manager function role that count towards active or significant participation, which allows you to benefit from this deduction. So just a good rule of thumb, and I know you're going to see a lot of articles online stating that you don't need to keep an hour log of your time. I would disagree with that. I think it's a good practice to do, to keep track of your hours as a real estate investor, if that's what you're wanting to do and manage properties, because it's going to give you more substance, more substantiation for your deduction, and your accountant is going to love it too, because they're not going to have to ask you all these different questions, and hopefully they are asking you these questions so that you're getting the most bang for your buck. In this first example, our favorite taxpayer Chipper happens to have one rental. It's a single family home that he rents out, and he actively participates in that rental enough, at least over 100 hours per year, helping repair the property, do some maintenance, make management decisions, help the tenants. So he's pretty involved. It's not just a passive investment for him. And you can see, based on the amounts of rent he collected, minus all the different types of deductions he had during the year to offset that rental income, on paper, he shows a loss of, or on this form, of $12,918. So currently, this rental is driving a loss, right? Now, can he deduct that loss? Well, let's go over to the front of his 1040, and we're making this super simple example so you can really grasp it, is that he just has one form of income, wages. He makes $100,000 from wages, and that's it. There's no other forms of income other than this rental, which happens to show a loss. Now, if you remember just from a moment ago, if our income is $100,000 and we're actively participating, we can deduct that loss to the fullest extent. So you can see in the highlighted row there on line 8, there's an other income item, which is showing a negative number. That is the loss coming from Schedule E, the rental schedule, onto the front page of Chipper's 1040. Thus, he is able to deduct that loss in full. And instead of paying taxes on $100,000, Chipper now can pay 80 taxes, or his total adjusted gross income is $87,082 before the standard deduction. Now, on the flip side, what would happen if Chipper, if instead of making $100,000, let's say he made $150,000, well then right away, he's going to lose that ability to deduct that loss against his other forms of income. If we flip over to the 8582, you can see here that on part 2, it looks at Chipper's total income versus what the limitations are. Notice that this $12,918 loss from his rental can no longer be deducted against his other forms of income. So what it does is it moves up into part 1 as an unallowed loss, an unallowed passive loss, and it carries forward into the next tax year. So if this is 2022, then it carries forward as a passive loss into 2023. Similar example again, but let's say now, in this case, Chipper's income is not $100,000 or $150,000, but it's $100,002. Now remember, For every additional $2 that Chipper makes over $100,000, it's going to reduce his ability to deduct the $25,000 by $1. So when he makes $102,000, his potential $25,000 loss deduction, if his loss was, now the loss has to be that big or more for him to get that amount, by the way. But in this case, it's not. It's only $12,918. But you can see that if it were $25,000, his loss would be immediately limited to, on line 8, $24,999. So you can see here, every $2, this amount on line 8 is going to drop by $1. Now, because his loss is far below $25,000, he's still able to deduct the full loss in this example, but you can see how that might play out. Let's look at one more example. The question becomes, knowing that the loss Chipper has from his rental is $12,918, what income level can he have and allow us to still deduct the full amount of that loss? Well, if in order for him to be able to deduct the full amount of the loss, if you look here on line 6, his income could not exceed $124,164, because that is the point at which, if he started to go above that, he would start his loss of $12,918 would start to become reduced dollar for dollar. In these 4 different variations, you can see how each different income level can impact the amount of that passive loss we can deduct as a non-passive loss. So the more income we make, the less likely we're going to be able to take it. The less income we make, the more likely we're going to be able to take it. And that's generally the case with most tax laws. The less you make, the more you can deduct, typically, because there's less AGI limitations that you're hitting. Now, this is an exercise I like to do with my clients, especially who have real estate investments, is to, if I'm talking to them and I can see they're relatively close to being able to deduct this, then we might do some tax planning. We might do consulting to see what they're planning to do with their property, what type of, if they're planning to make any improvements, renovations, or, just what the current state of that property is in the present year. Because as much as possible, my goal is to help drive their income below $150,000 if it makes sense to do so. Because if it does, if there are ways they can do that and then get a greater loss deduction, it will save them tremendously more in tax deductions for that year. And so that's the kind of work I do with my clients when I'm looking at their financial picture, talking to them about the future and kind of what they're hoping to achieve. So I hope from this example, though, you can kind of see how this real estate loss works. Remember, you can deduct a loss of up to $25,000. Of course, your loss has to be $25,000 in order to be that. If it's less than that, then you can only deduct whatever your loss could potentially be. You have to make less than $150,000. By $150,000, it fully phases out. And you have to at least be actively participating in the rental, which means that you've put 100 hours or more in to reach that active participation level. All right, ladies and gentlemen, I hope you got a lot out of this video and learned more about how this loss deduction works and how it can benefit you if you own rental properties. Until next time, I hope you have a fantastic week. I'll see you in the next video. And if you haven't checked out some of these other videos, go ahead and take a moment to check them out. All right, guys, take care. I'll see you in the next one.